Hey everybody, happy Tuesday to you. My name is Brent Moores. Time for Long Options. Glad to be here, and I'm glad to be joined by Connie Hill, who's helping me out in the chat. She always does a great job. She's very familiar with what I'm going to be going through today. Not just options, but the Thinkorswim platform, the Thinkorswim desktop software we'll be covering today. So make sure you ask questions between Connie and myself. We'll do our best to help you out. And you can follow us on X as well, at Brent Moores CS, at Connie Hill CS. And today I want to talk to you about, mastering the Theoprice tool to try and help you out with your options trading and give you some options trade examples as well. But before we do that, we do need to get through some disclosures. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not an individual recommendation of any security, chart pattern, or investment strategy. And let's see, all investing involves risks, including potential loss of principal. May not use commissions or fees when we do these practice trades today that we do. Just realize those are a real thing, something you need to factor in. And there's no guarantee an execution of a stop order will be at or near the stop price. And past performance of any securities or strategy does not guarantee future results or success. There we go. I think those are the main points I wanted to bring up right there with you. Let's head on over to the Thinkorswim platform. Where are we at today? But mostly even today. Down just a smidge here on the S&P 500. But what I want to talk to you about is I want to talk to you about doing trades. And each week in this class, we do trades. And we usually end up doing stop orders or target orders of some sort, some variation of those. Probably more often than not, though, in this webcast, we are talking, we do them based on the stock price. Let me just give you an example here. And for this, I'm going to pull up FedEx. Just by the way, of course, we've just started. We're at the beginning of earnings season. So there's a lot of companies that have earnings coming up. For the most part, the examples I'm going to show you are ones where I'm intentionally avoiding earnings. You can trade over earnings if you want with a long option. Now, question, what's a long option? Okay, long option just means we're buying it. Chris answered in the chat. Thank you, Chris, for that. And I always appreciate you guys in the chat helping each other out. Long option just means we're buying the option up front. Just like when you buy a stock, technically it's a long stock. We don't really say it as much that way, but when you buy something up front, it's long. It's not referring to how long we hold on to it. You could do a long option and get out 2 minutes after you get in. That's still a long option. You're still buying it. So if we are buying an option before earnings, that is certainly a possible thing. Implied volatilities, pricing on those options may be a little bit higher, which kind of works against you, but you also get more potential movement, which may be a good thing. So, there's pros and cons to it. But for the most part, I'm going to avoid earnings today here on this. But let's say we were doing a trade on FedEx. Okay, this is what I have here. I'm going to look at a bullish trade. I'm going to say, hey, we're bouncing right off that 50-day moving average right here. Okay, bounced back here off the 50-day. General trend has been up. And if I want, I can look and say, hey, most recently we were here, and we can look to put in an exit order if we break below that, maybe a couple percent below that. We'll just say, for our purposes here, around 222, we could look to exit that order. Okay, if it goes against us on that, or we could say, oh, I'm gonna kind of make a target price up here around 240. Okay, and we could put in a target price at 240. And if we were to just do that, and I'm not going to actually do the trade here because I just want to kind of illustrate this point here for us. If I were just to do this trade right here, and let's say we were doing a long option on this, I'm going to go at the money or close to the money here on this. I'm going to go do a call. Stocks at 372. I could right click on this. I could buy custom with stop. And then what I can do on this is I can change that stop to a market order. I could change market today, and then I can click on the gear. And what the gear does is it enables us to, when I click on the gear, it brings up a window. Okay, came up on the other screen, so I got to bring it over here so you can see. It enables us to do this trade and put exits. Hold on. How'd I get Adobe? I want FedEx. Okay. We'll look at Adobe later, actually. Thank you, Chris, on that. I don't know how anyway, anywho, let's go back. We're going to go here. I'm going to right click on this and I'm going to buy custom and with a stop. And I'm going to make this, I'm going to make my sell order a market order, good till canceled. A lot of this for you is review. Click on the gear. And then what I can do is I can go down here and I can say if FedEx marks or price is greater than or equal to, what we say, 240, okay? 240, or if it marks or price is less than or equal to 222, we're going to get out. So save, confirm and send. I'm not actually going to send this order, but let's look at this. So here's our order to buy the option price, but, here's an order to sell if FedEx marks, the underlying stock marks above or below. So there's some pros and cons to doing it this way. One of the pros is we connect it to, in a sense, our technical analysis. In other words, I'm just going to delete this, okay? In other words, when I'm looking at this chart and I'm doing this technical analysis on this chart and I see, oh, this is going to be a target level, it may make sense to get out of the option if we hit the target level, or my stop is going to be down here. It may make sense to get out if the stock goes down there. The chart is the technical analysis, and we're connecting it to the trade directly by doing it that way. Now, just because we say we're going to get out at a certain price doesn't mean we're going to get out, right? There's a difference. You know, we read that disclosure at the beginning. Stop orders don't guarantee exactly what price you're going to get out at. Okay, that's fair enough. That's true with any way we do that. That's the nice thing about doing it this way, and that's something we do almost every week in this webcast, is we connect them to the stock price. But you don't have to. You can say, I want to get out when the option is at a certain price. But that begs the question, what's the option price going to be if the stock goes down to 222 or up to 240? That's where we go up to the trade tab and we can go here, and maybe it's on something else right now. Click right here above that option chain, click on Theo price. That stands for theoretical price. In other words, what's the price of that option going to be at different levels? So let's do that same option, but let's think about what price this stock is going to be, this option is going to be, excuse me, if the stock goes up. Okay, if the stock goes up. So let's go and look potentially at this trade. Okay, so let's see, stock's at 230 now, right on the nose. Okay, so let me go to 230 and let me go right here on this. So what price is this option going to be if the stock goes up to 240? Well, first of all, it gives me the mark price, halfway between the bid price and ask price, about 40 cents difference, 45 cents difference between the two. Our general rule of thumb in this class is when I look at my bid and ask price, I want them to be less than 10% within each other. And they are. There's 40 cents. A $10 option, that'd be like $1 difference. We want something tighter than that. Ooh, you see it's widening out right now. That's bouncing around. Here's an easy way to address that. Typically, if you go to, we'll do this. go out to a weekly option, typically your spreads are going to be, the monthly options, the regular monthly options, then that's what we're going to get. So let me look at this 230. There's our tighter spreads on this. Okay, now let's look and see what we got here. Stock is at 230. Stock's right around 230. Here's our option at 675. If I want to exit, if I want to know what price this is going to be at 240, I need to add, I want to say, what if this stock goes up $10 to 240? What would that be? So I'm going to go to my Theo price right over here. I'm going to put this up $10. Okay, now you can do a plus sign in front of this or a minus sign in front of this. And if I want to be exact to 240, it's going to bounce around a little bit. I could say plus 1007 or something like that. Right at 240. This tells you what the price is. And, well, it's presumably not going to occur today. What if it takes a week to get there? So I'm going to go forward a week in time. Now, why does it matter? What does it matter if we change the date here? Because there's time decay on this. This is a negative theta trade. In other words, time decay is working against us on this. But let's take a look at this now. Okay. Now, if the stock were to go up to $240 in a week, the option would go up from approximately $8. Now, let me emphasize the word approximately. Excuse me, I was looking at the wrong contract. From approximately $6.65 to $12.14. Okay? And so that gives me an idea, if I hit my target, what kind of profit I'd be. Now, is that going to be exact? Probably not. It'd be surprising if it hit that exactly to the penny, right? But that gives me a rough estimation of that, and I could indeed then put in a limit price on the stock at $12.20, right? $12.20. And so there we go. Let me just jot that down. $12.20. Well, let's do the other part of this, okay? Let's do the other part of this. What if the stock goes against us and therefore the option loses money? Well, we said, what if the stock goes down to $222? Well, let's see what we got. I'm going to click on my Theo price. I'm going to reset this. Now, again, I'm going to go forward about a week's worth of time here. So we'll go there. And my stock price adjust is going to be about $8. So I'm going to put a minus sign in there, $8. And that gives me pretty close. It's going to be just a smidge less than $8. $7.95 minus $7.95. We'll put that in there. And now when I click on this, I can look at my contract. I can see my price would have gone down to about $240 in that case. Okay, about $240. So that gives me a sense of where I'm at, $240. If I'm starting out with this price, $670, and I were to indeed sell out at my target at $12.20, and my stop, if we were to indeed get out where the stop would be, which we don't know for sure, of course, on these prices, that gives me a little less than about a $5.50 potential gain on that, if I'm doing my math right. I think I am. And in terms of my potential loss, I'm going to use my calculator on this one just to make it about a $4.30 potential loss. So a little bit better than a 1-to-1, about a 1.2 to 1 reward to risk ratio. Okay, so you can use that ratio on there. And if I wanted to do this trade, I can then do this trade here. If I am going to do it, instead of doing the process I went before, I can simply right-click on this, on the ask price. I can buy custom with an OCO bracket. Well, what does that mean? It means we're buying, so first triggers OCO order. So the order's not going to actually fill unless the stock goes, unless the first trade fills. And then I have a limit price and a stop price. The limit price is the target price. What was my limit price going to be? My limit price was going to be 12.20. 12.20. My stop price is, let me just increase this a little bit bigger so you can see it a little bit better. My stop price is going to be 2.40. These are both going to be good till canceled orders. What just happened there? I don't know why that just disappeared on me. Let me do it again. Okay. Right click, buy custom with OCO bracket. That's kind of weird. It was when I switched to good till canceled, it did not like that. Our limit order and our stop order. Our limit order was 12.20. Our stop order was 2.40. So this is a little bit of a different approach than we often do in this webcast here. And then what I can do, you can obviously control the number of contracts you want to do, and then you can click on confirm and send if you want. Let me just change this. Mid price is 680, or mid price is 670 natural, so that would probably fill there on this. Let me make this in our long single options category. And let's just kind of review. Max profit is theoretically infinite. That's because long options can go up and up, theoretically, but more than likely we'll get limited out of the order around the 12.20 level, although we don't know exactly what price that will be. Max loss, $680. We could lose everything. Even though we have a stop order on it, we could lose everything. We just don't know there. Now, let me go, and before I send this, let me just double check some of these comments in here. And it looks like Connie's answering questions there. How's your target 240 when the break-even point? So let's look at break-even points here on this. So break-even on this one is shown, it's not giving me anything on this break-even. But let's just kind of work that through. Let me click on send. I sent that order, that's filled. Keep in mind when you're looking at these items, when we talk about break even, we can talk about break even at expiration. This is an important point. I'm glad you brought that up, Tatiana. Okay. When we talk about break even, we can talk about, typically what we're talking about is break even at expiration. Well, for our break even at expiration, we're going to take the strike price. In this case, and I realize I had a different trade up when you were looking at that, but I think it will be applicable. We take the strike price and then add on the price of the option contract, which I think was about $6. I don't remember exactly what it was, but it was something like that. That would put our break even at expiration about 236. Now, does that mean that the stock needs to go up to 236 to make any money? The answer is no. That's our break even at expiration. But if in the next week or two we go up before then we'd actually be making probably significantly more money than that at that point. So just make sure you don't confuse break-even prices at expiration with what we need the stock to do in order to make money on that trade. It changes over time, which is why, by the way, when we're looking at things like a Theo price, and let me just reset this. When we're looking at things like a Theo price, and we say, oh, let's put this stock up, say, $5, okay? That was below our break-even point on this, okay? And we did this one. Our break-even, remember on the 230 would be about 2 36.80 or so. But let's do this. Let's just say we did this in 3 days and it went up $5. We're below our break-even point on this in theory, but it's actually showing very profitable on the Theo price calculator, which of course is just an estimate. But 920 versus, we've made a nice profit on that trade because of we're not holding it all the way to expiration. Hopefully that answers your question there. That was a great question on that. Okay, so let's move on. Let's look at another one here on an existing trade we have. Because we have an existing trade on, clicking on the wrong category, on Adobe right now. So here's Adobe, and not a good day today. Overall, we're doing okay on this. This is a long put, so this is a bearish trade. We did this a while back in this webcast, I think, okay? Now, I have a stop loss on this of some sort. Let's see, I've got a stop loss at 17 on this. Well, right now, we bought the trade, we bought the put for 24, so we had a stop loss on there. And the current price is about 26, which is why we're making a little bit of money on this. Well, let's look at Adobe here. ADBE, okay? And we're bearish on this is the point of the trade. It's a long put trade. We're kind of right here. We're kind of at this precipice where we're looking for a bounce down. The trend has been down. We've had lower highs, lower lows, but we're like kind of at this point, we're saying, come on already, give me that bounce down. Give me this kind of bear flag bounce, which we want. Well, we're not seeing it yet. And I don't want to be premature on this, but I also would like to get out if it goes much more against us. At some point, I'm going to call it quits on this. My 20-day moving average, which is in red, is at about 375.5. Let's say it gets up to 378, or we'll say 379 even. What if we get out if it goes up to 379? What option price would we need on this? Well, let's look at it, okay? So let's look at Adobe. We got Adobe now, got the right trade up here, okay? Let's find our trade. Here's our trade right now. And I want to know what price this would be for if the stock goes to 379, our put here. Well, 379 is how much above where we're at right now? It's about $6.50 above where we're at right now. So I'm going to say, what if the stock goes up $6.50? Okay, and that gives me 379, so a little bit less than that. So we'll go 640, okay? That gets me right up to the 379 level. And I'll go forward a few days here on this. We'll go to the end of the week on this, okay? Say it continues to go against us. The question is, now that we have that, where should we put our stop loss, okay? Well, the Theo price is now showing at 2260. 2260. That's the Theo price. So if I want to adjust this stop up, I can move that to 2260, not 17. Okay, let me just jot that down, 2260. Because by the time this option gets to $17, that means where would the stock be at that point? That means the stock is more likely, instead of up in this range, it probably means the stop's up in that range, right? So I don't want to wait. I don't want to be that patient on it, because if, assuming we get out the stop price, remember we bought this for 24 bucks. I'd much rather cut my losses and get out at 2260 rather than get out at, what do we say, $17. So I'm going to adjust this price here on this. Okay, so let's do that. So I'm going to go to, how do we adjust an existing trade? I'm going to click on this cell. This cell is just kind of my existing price. I can, existing stop. on this. I can right-click on this and can cancel and replace the order. What does that do? It means it's going to cancel the existing $17 order, and it's going to replace it with this new one, which we said was going to be $22.60. $22.60. This is in the effort of trying to save us some money in case it goes against us. Does this guarantee we're going to get out $22.60? It doesn't, but hopefully it helps. Okay, so I'm going to confirm and send. And once I send this order, what happens is it cancels the other one. And now if I look at Adobe and I look at this cell, now it's showing that price up at $22.60 instead. So it's important, I think, yes, you can certainly do these trades. And in the future, I'm going to continue to do a lot of trades example trades, where we put the exit orders based on the price of the underlying stock. But if you're ever doing them based on the option price themselves, it's probably important to know how to use that Theo price tool that we've been demonstrating so that you can adjust it. Because even if you do a trade, let's say you do let's say you do a trade and just kind of reviewing some rules that we often use in this class. Let's say we're doing a swing trade and we're buying an option and we're buying the option. Often we'll put a stop and we'll buy that option somewhere around a 50 delta or something kind of at the money on this. Often we'll put in a stop loss that is around 50% of the entry price. So if we're buying a $10 option, call or put, often we'll put in a stop and just say, we're not even going to worry about the technical analysis support or whatever. We'll just say, I'm going to put that stop in at $5, okay? Or maybe we'll put in a target above that price. Same deal, okay? We put that in. But over time, let's say that stock moves up and the option goes up too. Let's say this is a call option, the stock goes up to $15, okay? Do I still want my stop order to be at $5? No, I'm going to want to move that up. Now, the one choice is I could just say, well, I'm going to leave it at 50%, in which case my stop would then be $7.50, right? Half of $15. Or you can do what we did on the Adobe trade, and we could kind of connect it to the stock price and use the Theo price tool to do so. Okay, so let's go through another example here on this to try and maybe hopefully illustrate the point. We went through a trade on FDX. We adjusted a trade on Adobe. Let's go through a third example here. And the third example I'm going to look at is going to be a slight variation here on this, and it's going to be ORCL, Oracle. Okay, so here's Oracle. Again, we don't have earnings for a little bit. By the way, so how do you tell when earnings is going to come? First of all, if you're on a chart, you can see past earnings right here. If you give yourself some space to the right side of the graph, that can be beneficial. And you have to make sure that earnings events are showing. So how do you do that? Go to the gear at the top of the page. Go to, under General, actually not under General, under Equities, go to Show Corporate Actions. That's going to show earnings and dividends. It's going to show these logos on the chart. That's an earning, that's the earnings, there's the dividend. Okay, so you got to make sure that's checked. Furthermore, if you want to add some space on the chart, to the edge of the chart, you notice I have a few days here, okay, on this right edge of the chart. You just go to time axis and go to expansion area, and you can add more days if you want. If I want to add 20 days here, I'm just going to type in 20, apply, okay. Now I've got 20 days into the future, and I can see if earnings is any time in that 20-day time frame. Okay. Now, so that's an easy way to do it. Another way to check out when earnings is, if you go to the Analyze tab and click on Earnings, it will say right up here, September 8th, we have earnings. Okay, there's another way. But one nice thing is having it on the chart is if it's coming up, it's just kind of like right in your face there. It's hard to miss. There's plenty of times I forget to look and then I see it right there. And then finally, one way, which is a little less precise maybe, is you can look at the last earnings. Look, the last earnings occurred on about June 10th. Earnings are typically going to come out every 3 months. So you can just go June 10th, July 10th, August 10th, September 10th. So we know earnings are going to come out roughly September 10th in that regard. So a lot of times, if you just want to be real quick on that and you're not showing it and you want to see, you can see how soon they're coming out for you on that. Okay, but let's go back to this potential trade. I'm looking at for a bullish potential trade. What are the requirements on a bullish trade? Well, first thing from a technical analysis standpoint, we usually look at the trend. Okay, that's number one. We look at the trend. Trend is, you can use moving averages if you want. Here's a 20-day, here's a 50-day. Stocks above those, they're both sloping upward. That's probably a good sign. The more technical definition of upward trend is you're getting a series of higher highs along with a series of higher lows, and so that's trend is the first thing a lot of technical traders will look at, and it seems like we've fulfilled that requirement there. Now, number two, support levels, resistance levels. Well, I don't see any resistance here on the chart right now. I don't know if we're at an all-time high or not on this. We can look back and just view real quickly. Let's go to longer term chart. I think we're at an all-time high on this. Okay, so that's a 3-year chart. And you can look for support. Well, we've been kind of increasing our support levels, bouncing. Each time we bounce off a new level, it's kind of a new support. We're waiting for a bounce here on this. We haven't found that. Okay, we haven't found that. It hasn't bounced yet. We'll see. We'll have to see. The other thing we often look at from a technical analysis standpoint is a bounce. So the bounce, in addition to kind of maybe helping to define where our support level is going to be, is also going to help us to look for upward momentum. Because right now, if we look at the stock's been going down. That's downward momentum. You can probably see this as well if you wanted to, if you have an indicator such as like an RSI or MACD. Here's an RSI, maybe a little hard to see, but that RSI is heading down. Kind of a sign of downward momentum on that. You don't have to even use that indicator though to tell us that, okay? And so, so what I want to see is the bounce. Well, the common bounce we typically use in this webcast, the most common bounce that we use in this webcast is what we call a hold or a close above the high of the low day. Here's our low day as far as we can tell right now. Now, tomorrow may be lower for all we know, but we'll have to wait and see. First, we identify our low day, which is there. We identify the high price of that low day. So let me zoom in here just a little bit, just so you can see. We're zoomed in. The high price of that low day is right there, okay? We can see 242.29. If you're wondering how I came up with that price, you can just look right up here where it says H for high, okay? 242.29 is the high price there on that, okay? So I want to enter if that stock goes above 240, my pen is not working, 242.29. Right. So there's my potential entry on that. That's like what we call it, kind of a contingent entry. We're going to wait until we get the bounce here. Because we can get in now. Let's say we bought a call option right now. Is that good or bad? Well, it depends. If the stock indeed goes up and we buy now, then we're getting in at a lower price, presumably on the option price, because the stock's at a lower price now. If we wait for the stock to go up and break above this level, then the call option will also have gone up by that point. That's not as great. That's not ideal. But if we are looking from a technical analysis standpoint, we do like to see that upward momentum. It means we're giving up something. In other words, we're giving up some of the price. We're having to buy for a little higher price, but we're also maybe have some more confidence, if you're a technical trader at least, that this is going to go up here on this. So that's a way to do it. Now, I can go, well, how much is that? What's that stock price? What's the option price going to be if the stock goes up to 242.29? Well, let's look at something that would be, say, at the money here. Let me go back down to about a month out. Our bid-ask spread's a little bit tighter on this. 242 is going to give us, we'd be looking at these for the at the money. 242.29, 240 is going to be technically our at the money contract. If we got in right when it was at 242.29, okay? So those are the pricing we're looking at here, okay? But that's not the price we're going to pay, probably. We're not going to pay $8.85. How much are we going to pay? Well, and this is, of course, just an estimate. I'm going to say, how do I get the stock to 242? That's about $4.09 if I'm doing my math right there. 4.09. 242. No, I was wrong on that. 29. $4.29. Okay. We'll call that close enough. It's a moving target a little bit to a certain extent. And we're going to say, well, maybe it takes a day or two to get there, okay? So I'll go to tomorrow on this. Now we can go to our Theo price and we can say, instead of paying about $8.80 or $8.70 as the mid price, we're going to be paying about $10.83, okay? $10.83. Let me just jot that down. So that gives me an idea of what I'm going to be paying. Now, I can go, there's a couple different ways we can attack this in terms of the stop order, but let's also just kind of look at it from this standpoint. This is, again, I'm going to kind of do this as a swing trade. And so what I'm going to say is, look, we just most recently swung up from low to high. I'm going to right click on this. I'm going to duplicate that, and I'm going to assume we get a similar type bounce here. Low to high. My new high is going to be about 262.90. 262.90. Okay. That's my target. Okay. That's my target price. And my stop, well, we'll put the stop in as maybe a percentage stop. Okay. Or, of course, we could put the stop in and we could do the same process. I'm not going to do it right now. A common way we'll put a stop on these is we'll go below the low of our bounce, because presumably that's a support level, and we'll go a little bit below that and we'll say, maybe 1% below that, maybe 2% below that, somewhere in this range, and we'll say, I want to get out if the stock hits that level. Okay? We can do that. The underlying stock hits that level. But here's what I'm going to do. I'm going to go here, and I'm going to say, look, we know approximately where the stock is going to be, where the option is going to be approximately if the stock bounces up. Okay. We can do that based on the stock price. We can also do it based on the option price. We can also mix and match, which is what I'm going to do here. I'm going to go to 240. I'm going to right click on this. I'm going to buy custom with a stop. Actually, let me do this with an OCO bracket. And I'm going to say, I want to get in if the stock goes up above 242.29. Okay. Well, I'm going to make this a market order. I'm going to make this a good till canceled order. In fact, I'm going to make all these good till canceled orders. Okay. I'm going to go to my gear, and I'm going to say, I only want to buy this if Oracle marks greater than or equal to 242.29. 242.29. That is based on the stock price, on the underlying stock price. What if I don't want to do that on the option price, though? What if we said, I want to get out if the, remember, we at say a 50% stop or something like that. Well, we knew when we were getting it in that the option was going to be about 10.83. 10.83. I'm going to divide that by 2. And that is going to put my stop at around 542. Okay, 542. That's going to be my stop. What's this stop based on? This stop is based on the option price, expected option price. We don't know what the option price is actually going to be, but that's what the assumption is going to be. Furthermore, what we could say is, what if the stock goes up? Well, we said the stock, our target was 262. What's the option? We can look at what the option price is. We can look at the stock prices on this. If the stock goes up to 262 as a target, I can go back here. I can go and I can look at my Theo price, and I can say, what if the stock goes up to 262? Right now, that's about $25 increase, less 50 cents. So 24.50. And that, presumably that's going to take a little bit longer. And I want to reflect that. I want to add the date time in there because there's going to be a time decay element of that. Okay, so I'm going to go out a couple weeks on this. Now when I look at this, and I look at the 240 strike, that Theo price is showing all the way up to $24. Now remember, we're not getting in. It's not like we're buying it at $8.50. Remember, we were getting in, it was close to $11 by the time we were getting in because of waiting on the bounce. So $24.27 is our target on that, if we were going to do it based on that option price. Let's go here. And we could do this and do 24.25, I think was our target. Okay, good. So canceled. So here's the point. The point is, you can do trades based on the stock price, which is what we did on the entry on this. You can do them based on the option price. The first two trades, our first two example trades, FedEx, Adobe, we did it based on the option price. This one, we could actually do a mix if we wanted to. Now, in real life, usually I do one or the other. Okay, usually we're probably going to do either based on the underlying stock price or the option price. This last one was kind of a mix and match here, but I just wanted to show you that that is possible if you wanted to. And the key to all of this is the Theo price tool. You need to get comfortable with that Theo price tool. So homework for you. Okay, let me just confirm and send. Make sure you read the red marks on here. Remember, stops don't guarantee you a particular price when they do get you out. Let me put in we'll put this in. That's a contingent order. Let's see, what did I do? Something happened here. Why did that? Something went wrong there. I'll have to look at that after. Did I do that trade wrong? That was based on did I not do it based on the stock price? I'll have to go back and redo that. At or above 0.01. I was too quick on that. Okay. So it was supposed to be at or above 242.29. Okay, I messed up. I somehow in there I had at or above 0.01, so it filled immediately. I messed that up. Okay, so I'll probably just exit that trade. Okay, I messed that up. Here's the thing, everybody, I got to wrap up. But my biggest point today was get familiar with that Theoprice tool. It's going to be your best friend as an options trader in your trades. We also went through some example trades, FedEx, adjusting stops on Adobe, new trades on Oracle. And so if you want to follow along with practice trades, you're welcome to do that as well. Thank you for joining me, everybody. Coming up, we have getting started with technical analysis. That comes up next. Thank you for joining me, everybody. Have a wonderful rest of the day, and we'll see you same time next week. Bye-bye, everybody.